Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by Jeff Santoro, my good friend, the voice of the people. Hey, Jeff.
Hey, how are you?
I'm fantastic, but I think we should start from scratch. What do you say?
That was well done. Well done. You're such a professional.
It's good, right? Yeah. Yeah. That's the title, people. That's the episode.
All right. Thank you. I'll see you next time.
We're leaving all of this in. So
absolutely.
Jeff and I had a conversation, and you're probably hearing this a lot from us the past few weeks, but it's a little bit inspired by some of the chats that are going on over in our Discord channel. That's part of the starter position, $5 a month membership through our Patreon. And what we're seeing is just as more people are getting involved in the conversation, different people in different walks of life talking about where they are on their journey. And we had a newer member who is a newer investor that's talking about basically hitting the reset button after when they started in the middle of the pandemic, finding their way as an investor. And even though this is a kind of a framework for an episode that we've done before, we want to do it again. And I think this is probably one that we'll do probably every year or so. We'll do another episode where we are talking about starting from scratch.
Yeah, I think the first time we did it was probably because I spent the first several years as an individual stock investor pining for the opportunity to start from scratch, because you learn so much in those first couple of years, and it's one thing to learn from your mistakes, but in a lot of respects, those mistakes stay with you in the form of positions that you maybe regret purchasing or losses in your portfolio that you wish weren't there. But the other reason to revisit the conversation is we are 162 regular episodes into this podcast, plus all the First Fridays and Rough Cuts and Misfit Monthlies and all the other podcasts. We're several hundred podcasts in, and we gain new listeners all the time. So it's worth revisiting some of the evergreen ideas and having some of the evergreen conversations, because we're middle-aged dudes who have been investing for a while, but we probably have listeners who are younger, who are newer to investing, who are making some of those mistakes that we all made when we were starting out. And I thought it'd be fun, Jason, to think about this conversation in two different kind of buckets. One being, what if you could start from scratch at age, let's just say 21 or 22, but today? Let's say you could begin again in 2025, but as a newly minted college graduate at your first job. And maybe we won't spend too much time on that. But then how might you start from scratch now? If you woke up tomorrow and everything you invested was now in cash for you to redeploy, what might you do differently or the same? So we can go in those two directions, and it'll be a fun conversation.
Yeah, one thing that we can build on from there, and I think this is one of the ways that this can be a valuable format to use, every year or so, or maybe even more often, is you talk about the early 20s versions of ourselves, which some of the people listening may relate to earlier in their investing career. You talk about where we are now, closer to the finish line than the starting line. But the environment that we're investing in changes, and financial goals change and get closer. And if there's any one thing that I've learned a lot, and this is something we talked about on last week's show, is as an investor, while whipsawing your strategy from extreme to extreme is dangerous and probably harmful, you should evolve over time, right? As things about what your goals are, when your goals are change, and the environment that you're investing in change as well.
Yeah. And that's kind of the journey I've been on for the past 5 years. Is I've talked about it on this podcast over all that time. So there's been a bunch of iterations of how I think about investing and how I invest. Very different now than it was even a year and a half ago, I would say. I've been pretty consistent over the past 18 months or so, but going back further than that, it's very, very different. So yeah, things change, and I think you should change with them. All right, so let's play the time machine game, Jason. Now, I don't think it's fair. We should not cheat. We should try to put ourselves back in the mental states that we were in our early 20s. So
Wait, let me go get a bunch of beer.
I was just going to say, so I'll be a good saver and you should start blowing all your cash on crap that you don't care about.
By the way, before we go any further, if you want to hear the previous episode where we did this, you got to go way back. It's more than 100 episodes ago. It's episode 56.
Yeah.
56. Okay. All right. You want me to start or you want to start?
All right, I'll start. So if I were...
Good. That'll give me time to drink these beers.
If I were 22-year-old me, but in 2025, I think, here's what I think would be the same and here's what I think would be different. So I would probably have the exact, maybe not exact, I'd say I'd have an approximately similar understanding of how all of this works that I did back then, which was not much. I knew enough to know you should live within your means. I knew enough to know people save money so that they can retire. That's kind of as far as it went. And I've talked about it before. I had to be basically kicked and dragged down to the teacher's lunchroom to meet with the guy to set up my 403B when I was a new teacher by a colleague of mine. And that turned out to be bad in terms of what I was put in, but at least I did it. At least I started. So I don't want to pretend like 2025, 22-year-old version of me would be this wise person. So assuming that, I would probably, and assuming I'm in the same profession, I probably would have set up my retirement account in a similar way. I don't know what that conversation might have been, how that conversation might have been different. I'm sure the products offered now are different than they were 25 years ago. But I'd like to think I would learn and figure some things out and maybe start getting into managing some of my own investments outside of my retirement account. So if I were to do that, I think, and this is where maybe I'm cheating a little bit, I think I'd build a base of ETFs or mutual funds or index funds or whatever you want to call them first. And maybe that's how I would advise other people if they asked me, if I ran into someone who was in their early 20s and asked how to start, unless they had this insane desire to research and spend time thinking about stocks like you and I like to do. And this is nothing new. I mean, Buffett says this, a lot of people say it, just go buy index funds and be done with it.
Yeah.
And build that base up. So I think as a starting point, that's what I would probably do if I could start over trying to approximate my level of understanding.
Yeah. When I was in my early 20s, I had absolutely no interest whatsoever in saving for retirement or investing writ large. I was very much like the poster child of money as emotion. I grew up, we didn't have money. You know, my parents split up in the early mid 80s when inflation was insanely high and interest rates were crazy and the housing market was awful. If that sounds familiar, you know, a lot of that macro stuff is similar, only it was a lot worse back then. And people made a lot less money. Unemployment was higher. Anyway, long story short, when you grow up like that and you're in an environment where your family doesn't talk about money and personal finances, every chance you get some money, there's a litany of things you want to go spend it on. And when you're an extrovert, you want to go spend it with your friends. So if there's one thing that I would hope, it's that if I would be able to just find some way to partition off a part of my money. And this is where I think, Jeff, the things that have changed over the past, call it 25 years since I was that age, would be wonderful for an idiot like me when I was in my early and mid 20s. And that's, you go to your first job and a lot of those companies immediately, like, you're opted in.
Right.
And you're opted into like probably at least whatever the company match is, maybe more, maybe like 3% or something. And you're generally also opted into every year, it increases the contribution. So just like those basic things would work wonders for somebody like me. And I think in a lot of ways, the me's of the world are the ones that are going to benefit the most from the harm of seeing the money hit your account and being able to quickly access it. And then there's the fact that fees are so much lower now. So all of those things would be beneficial. But I think broadly, yeah, and this is like the advice that I give myself constantly to make sure that it's the advice that I give my kid when he's not a kid anymore and he's an adult, but he's in the working world. And those of us that are passionate advocates for investing in individual stocks, one of the biggest mistakes that we often make with our family, our kids, people that we're close to, is we try to get them to be as interested in stocks as we are.
Right. It does not work.
No, it's the opposite happens. Yeah. So if it's just about teaching like the basic ideas of personal finance and delayed gratification and paying yourself first, right? And making it hard to get to those funds, like they're not even there, and it can really, really pay off. And eventually, sometimes they're going to be a me, where in my, late 20s, I became very interested in buying stocks, or somebody like you that, maybe you get to your late 30s and it's like, okay, I want to take a little more direct control over my financial future.
I think the other big difference, and this for me might have been a help, and this for you, I think also could have, but it also might have been the other side of it, which we'll talk about in a second, which is in 2001, which is when I graduated college, the internet existed, but like not anything like now. So there was no social media. Even checking your email was not a thing people were in the habit of doing regularly. Like, right. I think my first, if you don't count AOL, my first email address was like the one I got when I first started working, and no one checked their work email. It was like a thing you did like once a week. It's very bizarre that we lived in that world. But
when I created my Gmail account, I had to be like recommended by, like I had to have somebody like that had a Gmail send me a link to my AOL account to create a Gmail.
Right. But this is what I'm getting at. I've often wondered why, we're getting a little bit off on a tangent here, but I'll bring this back, I promise. I've often wondered why I found such a passion in this at age 40. But then when I look back, like I was the kind of person who, ever since I was making my own money and had either the check register, like the handwritten thing in the back of your checkbook, or eventually like Quicken, I kept track of every dime I spent. I could tell you where I've spent every penny of my money going back to the late 90s if I still had all the same files, right? I was interested in it from that standpoint. So I would imagine if I was that person in 2025, I'd be finding podcasts and Substacks and YouTube channels, and I would probably have found investing more than just ignoring my contributions to my retirement account much earlier. Now, the flip side of that, and this, I want to ask you this question, is I don't know how I would have handled at age 21, the other side of that, the fire hose of information, the get rich quick, the crypto, the stocks going to the moon. I don't know. Younger me might have gotten caught up in that and made some big dumb mistakes. And it feels like you certainly would have.
Oh, no doubt about it. I'm not saying I definitely would have gone to jail for buying something illegal on Silk Road with Bitcoin, but I'm saying that might have happened. So, but no, in serious, I mean, and that's the thing, like you can't, obviously there's no way to perfectly recreate who we are today if who we were 25 years ago started it today, right? So that's the impossibility, but trying to think around the aspects of things like the tailwinds that I think of, the changes in the industry that I think are positive are there. And honestly, I think as much as anything, the things that would have helped me are the things that would have been out of my control, that just would have happened automatically.
When I think about the stuff I did do when I was younger, I think the maniacal way that I kept track of my finances is actually a good first step for a lot of people. And this is like, maybe a way to think of this is how I talk about this with my older son, who's, he's almost 17, has a job, is going to be a senior in college, or senior in high school next year. He's got to start figuring some of the adulting things out soon. The idea that you have to keep track of how much you make and where you spend it, just so you know, right? The idea that you would have no idea how much you're spending on pizza with your friends or ice cream with your girlfriend or going to see movies, like just not knowing that if that's $50 a month or if it's $200 a month, like that first step of keeping track of where your money is going, I think is such an important first step towards all of the investing, because you can't get to the investing if you're living beyond your means, right? It's you have to have the excess income beyond what you need to survive to invest with. So I think that's something that I would try to instill in my younger self or my kids or younger people who I talk to. And then I guess like steps 2 and 3, the way I think about it is, and I don't know the order in which you should do these. I don't have a strong feeling on if you should do one versus the other first or second, or if you can try to do all of them at once. I've heard people who actually have degrees and certifications in this space say it different ways. So I think it's kind of to each their own. But the idea of building up the emergency fund to the degree you need to when you're very young. I mean, when you're very, very young, it's probably just a month or two of expenses because you don't have a lot of liabilities, and eliminating any debt you can, especially high interest debt, right? Like if you have credit card debt or things like that. I feel like those are some of the basics. And then index funds, or ETFs. Like,
Yeah.
I feel like I would try to advise my younger self to just keep it simple, stupid.
No, I think there's a couple things you hit on there. So number one, and this kind of builds on what I've already hopped on a little bit about the automatic things, but I think automating is hugely valuable. And that's something that is a ton easier now than it's been in the past, because everything's online. It's table stakes now for banks to have, a good online banking platform and the ability to automatically transfer X amount of money every month or on a certain date every month to a certain account, right? So you can automate all of those things because the evidence is overwhelming that people have better financial success. When they save more, they create more wealth when those things happen automatically. So leveraging those tools, I think you're 100% right about. And one of the things that I've come to realize when it comes to like the safety net, the emergency savings and all of those kinds of things, I think those things should absolutely fall behind paying off high interest debt. Because here's the funny thing about it. You're 23 years old. You've got your first apartment on your own. Maybe you have a couple of roommates. Maybe you got a car. Even that's becoming less necessary. But the point is, like, you have less and less like obligated liabilities that if you don't pay, then they start screwing up your credit. So you pay the repercussions for those for years and years down the road. The credit cards can actually be your emergency savings while you're aggressively paying off high interest debt. So if you have other debt that you've taken on that is high interest debt, like a credit card, for example, aggressively pay down the credit card. And if you have an emergency, well, you have to put something back on the credit card. That's okay. But you've paid that debt down, so you've avoided the interest in the meantime. So I think really being aggressive about like paying off expensive debt as quickly as possible and then starting to build up savings, I think that's the order you do it in. But I think the thing that you have to be doing in the background, even though the math isn't perfectly favorable, is getting that money in that 401k or 403b like in your situation, like especially in environments where there's free money to get, when there's any sort of a match involved or anything like that, you have to get after that, because the free money, that match, I don't care how good of a stock picker you are and how crappy the funds are that are available to you. If there's a match, if it's 25% of, the first 2% of your salary or 50% or even a dollar to dollar match, I don't care how good you are, you can't generate returns that are going to be better than that, right? So you have to get that free money. And I think even in the case, the last thing I want to say about it is, even in the case that you're paying 29% interest and in a good year in the market, you're going to get 20% in returns. On paper, it's smarter to pay off the credit card. You've got to develop those muscles of saving and investing. And I think building those muscles early can be just as important as paying off that high interest debt.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
I agree with that. It's funny because the reason I would say my wife and me, our investment savings have pretty much been supercharged over the past 5 years by a combination of a few things. The two of us hitting like prime earning years in terms of salary, right?
Yep.
Which just happens in any profession,
Right.
when you're in your mid to late 40s, right? That's just like how most professions work. Not all, but a lot. And also me being maniacally focused on all of this and making optimization changes and honestly just way increasing my contributions to try to make up for the fact that I did very little for the first 12 to 15 years I was working. But it's the whole reason I was even the biggest reason we are where we are now in terms of being set for retirement is because my wife, who doesn't care about or think about or want to talk about any of this, from the moment she got her very first job, set up a 401k at the percentage of the company match.
Yep.
And then she set up a system for herself where every year when she got her raise, she'd log into the system and she'd increase the contribution percentage by 1.
Yep.
And so it went from, I think the match at first was maybe 6%. So then it went to 7 and then 8 and then 9. And then eventually it got to the point where she stopped doing it because she hit the contribution limit, right?
Right.
Now, she had no idea about any of this, but I distinctly remember I was actually at her parents' house with her right when she got her first job. She was talking to her dad about having to decide all of the funds to invest in. And she just picked whatever funds were there, 20 something years ago. But the big thing was she did the match. And really she made no changes other than when she switched jobs. And then eventually when I learned all this, I made some changes over the last several years. But to this day, 45% of our invested wealth is her 401k.
Yeah. Yeah.
And it's just because in 2002, she signed papers and put the minimum contribution to get the match and compounding and time and all that stuff. And so, yeah, that's really solid advice.
So there's one thing about what your wife did that I think is important. And I think this is a really important part of the wealth creating journey that we honestly, I don't think we talk enough about, but we've got somebody that's coming on the podcast that we're going to interview, Nick Mazzulli here in the coming weeks. He's got a book that's coming out. And one of the things that he writes about a lot and he's tweeted about a lot is the importance of focusing on earnings, not like directly focusing on it, but if you really want to create wealth, find ways to earn more money. And in your wife's situation and my wife's situation, there's a little bit of similarity in that they work in an industry where if you're really good at your job, you can earn more money and you can grow your wealth that way. And if you can grow your earnings, 2 or 3% a year faster than the average, right? That really compounds because that means that's more money that you're putting into your 401k. The quicker you get to the match, the more you have excess money that you can now put in savings. You can buy a nicer house. That house is going to gain in value. It's going to appreciate and be worth more dollars, even if it grows at a similar percentage in value, right? So just increasing your earnings capacity, that is another thing that if I could have explained the idea of that to younger me, would have been extremely valuable. And I want to differentiate here the idea of chasing a bigger salary versus just finding ways to increase earnings, because there's a lot more than just making more money to drive satisfaction in your life. But it is something that around the edges of our careers and our pursuits that I do think is something that understanding that idea in terms of we all have 24 hours in a day that we can use. How can we use those 24 hours to reach all of our goals, whether they're personal pursuits and around things with our family and friends that we want to do, personal interests, professional goals, financial goals. We have a finite amount of time that we can put towards those things, and finding ways to optimize the amount of time you put towards the things that are going to get you the best return is really, really important.
Yeah. And I think the other side of that coin too is, because I've seen different people have success here in different ways. I know some people who, and maybe this is because I work in education and therefore know a lot of teachers, where the whole idea of like making 2 or 3% more than your peers is not possible because everything is on a salary guide and it's just predetermined.
Right.
But I also know people who they make fine, good money, like they're not wanting for things and they can do all the stuff they want to do, but they're just people who they're not spenders. They don't need to drive a fancy car, have a huge house, or go on a lot of vacations. They're perfectly happy just being, people who live within their means. So I think it can be both of those things and should be both of those things.
Right.
Because there's
even within the education community and public education, if you increase your skills, certifications, knowledge, make yourself more valuable, you're going to earn more money.
Yeah. Well, and the other positive side as it pertains to money in education is if you do find something on the side you enjoy that pays a little bit of money that you can do in the summers and on weekends and at nights, because you're home from school at 3:30 in the afternoon, right? Because you teach high school and it gets out at 2:20. Like there's ways you can find, and then you can, in a lot of places, a little different now in New Jersey, they've changed some stuff, but you can retire earlier than a lot of people who are in non-teaching professions. So if you can find a side hustle that you can turn into a post-career profession or hobby, or that's another way to kind of add to that. All right, so I have one question for you about younger you, and then I want to talk about what we would do if we started over right now. Do you think if you could talk to 21, 22-year-old Jason Hall, would you tell him to invest in individual stocks back then, or would you advise some level of index funds, mutual funds, ETFs as a starting point?
No, it would absolutely be take this amount of your payroll every pay period and make it go into your retirement account, and take this percent and make it go into this savings account that's at this other bank that you don't even have withdrawal slips for, and it's in another town. I mean, I'm serious. Like,
it's guarded by alligators in a moat.
Yeah, exactly. Like, no, but it seriously would be, let's make this money disappear and limit your access to it. And in time, and I think maybe one of the things that might have been compelling to me is if somebody had have sat down when I was 21 and said, let's show you what happens when you're 35, what this is going to be worth in 35. If you just forget about it and just use like a really reasonable, like 7 or 8% a year. I mean, the timing for me, this would have been in the early 2000s that this would have happened. If it was 1999, that would have been a terrible time. If it's 2002, it would have been a good time. But like track it across like the ups and downs of the market, not just some linear CAGR number, but look, here's what it looks like across an actual market environment. And this is what it could be worth to you in the future when your priorities are going to be different, when you're going to be thinking about being married and having kids and other things, and you're going to need money to do those things, because if you don't, nobody's going to be interested in you. Finding ways like the incentives, what would have compelled to stupid me, and it wouldn't have been stocks back then. It would have been just having money in the future.
I love that, because the thing I truly didn't know, even I would say 6 years ago, 7 years ago, like that recently, two things I didn't realize. I didn't realize to have like an actual comfortable retirement right? To get to age, let's just use 65 as like the default for most people. Like to get to age 65 and have enough money to live comfortably, continue your quality and standard of living, and maybe do a little more traveling or whatever until you're can no longer do those things. So let's just say until you're in your 80s, just to be generic and pick a time frame. So for that 15 to 20, 25 years, right? You have to have millions of dollars, right? So like, I didn't know that. I just didn't know that you needed to have millions of dollars. The other thing I didn't know when I was 22 is that I thought having that much money was something only like really, really rich people could do. And I mean like, oh, that guy is the executive vice president of this publicly traded company. Of course he has millions of dollars. So that guy owns 4 laundromats in the central New Jersey area. Of course he has a couple $1 million. Like I had no idea that by just saving a little bit each month, but starting when you're like 16, you can have millions of dollars when you're 65. Like I had no idea about compounding, about saving. Like, so I think that's what would have convinced me back then to get into this earlier, was being like, no, even you, Jeff, making $35,000 as a teacher can get to this point. You just have to be consistent and dogged about it starting yesterday, you know?
Yeah. But here's the thing, right? And the other thing that's hard to comprehend is like, we think about inflation as this thing that happens, it's a couple or 3% a year. And we only think about a couple or 3%. But just to throw a number out here to just show you how inflation works, $1 million in 2001, that'd be about $1.8 million today, right? In terms of what $1 million would have bought in 2001 would take $1.8 million today. So like understanding those concepts, that what does that work out to? Basically $600,000 in 2001 would be the equivalent to being a millionaire today. It's like the understanding how like compounding works both as a good thing and a bad thing.
Right.
And it would have been easier for me to understand back in 2001 if somebody had have said, you know, you need about $600,000, you know, to retire.
Yeah,
Okay, I can do that. But then, you know, that's $1 million today. And obviously the lifestyle that we have now, you know, you need more than that. But then you start factoring in Social Security. Like you're in a situation where you'll have a pension too. So you start like putting all of those little pools of income and wealth together. And like, again, the idea though is to put put the numbers into the context that would have appealed to a younger me and would have felt like something that I could do.
Yeah. Yeah. No, I totally agree with that. And that's where, like, you know, your earlier point about the hard thing about being someone who loves stocks is you want to talk to everyone in your family about buying stocks, but no one wants to talk about buying stocks.
Yeah.
The part that I have put my foot down on a little bit is trying to at least explain this stuff to my kids, right? Like, you don't have to buy stocks like that. I have some stocks in an account for you guys, just so you have them in case you decide later on that you're interested in that and you can see what they've done over the past 10 or 15 years. It's just like, it's like $1,000 total here. But it's worked with my older one. I've pretty much, you know, brainwashed him into, you know, he gets his paychecks for his summer job and the app he uses to keep track of it takes 10% of everything that hits his account and he puts it into a little envelope for his Roth IRA. That's the word I was looking for.
I was just going to let you struggle with that if you were wondering.
I've been thinking a lot about 403B, so I was about to say Roth 403B, but that is not what he has. His Roth IRA. And I just tell him, if you do nothing else, if you listen to nothing else I tell you about money, if you do this one thing forever, you'll be fine.
Yeah.
All right, let's pivot. So let's say you're starting over right now. You can change anything in your portfolio or in your process at age 53, which I assume is how old you are. And
you're so mean.
What would you do differently? Anything? Would you change anything if you could? If there was no consequence to like selling things off and paying the taxes and all that kind of stuff?
This is apropos because when we did the episode 56, it was mostly motivated by your evolution, right? You've basically been through your like stock picking college over the past 4.5 years. And I think you're pretty much done with grad school at this point. Like you kind of figured it out, but you were still, kind of going through that. And the interesting thing is that anybody that's listened to this podcast for at least a year has heard me go through an evolution where it's one of those things where just a couple of factors have come into play. And last week's episode, we talked a lot about humility. And I think as an investor, where humility comes in is your ability to recognize the things that have happened, good or bad, that you should get no credit nor blame for. There are bad things that are going to happen that you have no control over and that weren't directly because of something you did. There's also a lot of good things. And of course, there's lots of good and bad things that you're directly responsible for. And humility is the ability to discern like the difference.
Mm-hmm.
And it's probably the most powerful teaching agent when it comes to being an individual investor, because you can see through your own bullshit and really try to improve, right? So the things that I've had zero control over that have been massively valuable is the market that almost the entirety of my time as an individual stock picker has taken place in. It was really so 2007, I think, is when I first joined the Motley Fool, maybe late 2006. But it wasn't really until 2009, 2010 that I started really buying stocks, right? Making those picks. My God, what a perfect time to be rolling over $76,000 from a 401k into a rollover account and start picking your own stocks, right? I mean, it doesn't get any better. And then from then all the way through the pandemic till now, we're talking 15, 16% average annualized returns. Yeah, 50 or 60% better annualized returns than the market's 10% a year long-term average. I want to be clear about that. 15% a year is not 5% better than 10%. It's 50% better.
Right.
I do not deserve any credit for that. And that has generated a massive amount of the success and the wealth that we've, and I don't want to make it sound like I'm sitting on buckets of money here. They're more like pails, like the small buckets. I'm kidding. But no, but again, the point is, trying to find that humility and not accepting any credit for that. And also being able to acknowledge that as the environment has changed and as we have gotten closer to some of those goals and looking at this amount of wealth we have now versus what we'll want to have in 10 years when my son graduates from high school, roughly that same period of time, 10 to 15 years before my wife and I make decisions about what kind of work do we want to do and do we need to start using our wealth for income. And it's okay, we can make some changes and de-risk. And so I've already kind of gone through that evolution, and it's been largely by moving into more of the bond funds and increasing the amount of cash that I hold. And luckily, since the vast majority of our wealth is in retirement accounts, we've been able to be okay, what are the implications? Oh, that's right. Everything's tax shielded. There are none. We can basically hit reset. And it's the kind of thing where we don't have to do a full reset. It's more of just okay, we need to change this one little thing a little bit. So being able to be objective about it. And Jeff, I'll be honest with you, having this podcast and being able to have these regular conversations with you, in addition to our investor group, which now includes a bunch of new friends that are total strangers that also give us money, which is kind of sweet with our Patreon, is also refreshing because you get to see different points of view from people with different expertise and also in different places in their investing journey. Some a little later than me. So I'm not the old guy in the room anymore.
All right. So then I have a definite thing I would do differently. So let me go mine first, but here's the question I want you to think about while I'm explaining what I would do differently. Because we have a mutual friend who has recently been talking to us about a job offer that would require them to liquidate their portfolio, because it would be stepping into a regulated financial job where they would not be able to own individual stocks. And I have friends in my life who work for financial firms who aren't allowed to own individual stocks. They can only own ETFs. So I have a friend that works at the Treasury Department. It's the same thing. So the question I want you to think about, and then I'll come back to it, is if you had to step into a role like that tomorrow, meaning you had to sell all your stocks, but then a year from now you stepped back out,
Yeah.
right? So now you have the opportunity to look at your stock portfolio. Forget the bonds, leave that where it is. But like, I think the fun conversation is, what would you do differently if you were starting over with a stock portfolio? So that's what I want you to think about. I think what I would do differently if I was, so the exercise I played in my brain thinking about this episode is, if I could sell all my individual stocks, which is a small part of my overall wealth, we've talked about this, and just start my stock investing from scratch, right? Because I think about that all the time.
Yeah.
What would I do differently? And there's what I think I would do, and then I question whether I would actually do it.
Yeah.
Because part of me says I would start with just a few individual stocks, because I don't have the portfolio risk of I'm investing for the very first time, right? If I was 22 and had $10,000 and I was tasked with opening a brokerage account or an IRA and starting up a stock portfolio, I'd buy like 30 stocks with that $1,000 or $10,000, and I'd spread it evenly, and then I'd build from there. But if I could redo my stock investing right now with all my money in index funds, mutual funds, ETFs, things like that, I think I would just buy maybe just one at a time, or like a few, like my 5 most high conviction ideas, and then just wait till they're bigger. Wait till they are a few percentage points of my cost basis of my overall portfolio or something before branching out. I certainly wouldn't go straight to having the 40-ish stocks I have right now, because it's really hard to make the decision to cut bait on things you already own. Like, that's the thing I'm struggling with, because I have enough conviction not to sell those things, because I think that things could turn around, or they're just in a rough patch at the moment. But if you ask me if I would buy them from scratch right now, I'd probably tell you no. I'd probably wait, which maybe is a sign that I should sell them and just, I don't know, whatever. But that's unique to just the fact that I'm already so invested in funds. So that's what I would do. So what about you? You're starting from scratch. You have all that money in cash, and you have to buy stocks again. What would you do differently?
Well, it's funny, because this is something that, to a small degree, I kind of already went through.
Oh, that's right. You did.
Sort of. My wife changed jobs probably 2 years ago now, a little over 2 years ago. And we did a rollover from her 401k at her former employer. And of course, there's no, like, doing a direct transfer is almost inexistent. So like a direct transfer is where they actually just transfer the assets that you own over to your new brokerage. What they pretty much all do is, they liquidate everything, and then they'll cut a check, ideally to your new institution. You don't want to touch that money.
Go straight to them. Yep.
Yeah. So then you have to rebuy everything. And of course, I went into it with, I'll just rebuy everything. And then the money hit the account. And of course, all the things that were going on at the time were going on. And I'm like, I can play this right. I'm smarter than the market. And the market probably went up from the time the money hit the account until I finally allocated everything how we wanted to, probably 6 or 7%, which, I mean, that's not nothing. That's a lot. If you really boil it down to the grand scheme of things, for somebody that had been at an employer for 15 years and was just entering their prime earnings years and was maxing out their contributions and had a pretty aggressive match. So it was not a small amount of money that, and it was, you can say it's bad luck or good luck or timing, but frankly, it was an unforced error. I made the decision to try to be nimble and outsmart the market. And it wasn't the most optimal thing to do, which would have been just to chalk up that week from the time that the liquidation happened before the funds cleared in the new account, and just go in and spend an hour just buying. And whatever the little variances were over that week were going to be whatever happened over that week. But I did a forced error. I'd probably do the same thing again, if I'm being honest.
It's funny you say that, because I actually did a similar thing, but at the wrong time in my education. So I rolled over my wife's. So my wife had a 401k from a job she left in 2008, and we just left it there until 2020 or 2021. Obviously, she wasn't contributing to it anymore, but it was just there doing its thing. I didn't even know you could do that. I didn't even know you could roll something over until 2020 when I started getting obsessed with all of this investing stuff. So as soon as I figured it out, I rolled her old 401k into an IRA. I rolled an old 403b that I had from a district I was at. I think I might have done 2 jobs ago. I just like took all my old 403bs and rolled them in. But I did all that within that first year of me like really getting excited about all this. Like that was one of the things I did during the pandemic as I was constantly reading and learning. As soon as I learned like, oh, I can roll this over, I just did it. So then I'm allocating those funds in their new IRAs suboptimally. I was a little bit smarter about it with my stuff. I rolled it into a IRA, and I think you and I were friends by this point. I remember talking to you about it. I every month I took a certain dollar amount from that big slug of cash and I bought stocks with it, but I forced myself to spread it out. So it took me like a year to take a little bit each month and buy stuff, which was probably smart because I'd like to think that the last couple times I bought from that cash, I was a little bit smarter than the first couple.
Yeah.
But I rolled my wife's over around the same time. Now she didn't want individual stocks, so I put all of hers in ETFs. So that was a little bit less of a stock buying decision, so to speak. But man, if I had thought to say to myself, okay, you're excited, you're interested, you know how to do this, you should wait 5 years.
Right.
And
but here's the thing.
But
like,
I mean,
waiting the 5 years, you would not have been doing for the 5 years.
Well, but it's not like it was in cash, right? Like they were in funds just sitting, not being contributed to,
no,
right?
But when I'm talking about the doing, I'm talking about the act of studying companies and risking capital and making those decisions that I think are extremely, extremely important. I don't think, and I wrote this on our Discord to one of the newer investors that was talking about the past 5 years, is you have to go through it. I firmly believe you have to do it. You have to pick the stocks. You have to risk your capital. You have to know what it feels like to watch a stock fall 20%, to go up 20% for what looks like no good reason, go through a period where macro stuff gets weird, because it's not just seeing what the stocks do, but it's seeing what you do. And when the stakes are lower, the numbers are smaller, it's a much, much less expensive education than when you're 45 years old and you've got $1 million that you've saved up over the past 20 years in a 401k, and you roll it all over into cash into a rollover one day, and you've got $1 million, and this is the first time you've ever started picking stocks. That's a very, very different situation to find yourself in.
Yeah. The other reason I'm not really mad at myself for doing it when I did, and I'm glad I didn't wait 5 more years, is both my wife's old 401k and my old 403bs were in funds, mutual funds that had higher expense ratios than the ETFs and index funds I put them in once I rolled them over. So that would have been 5 more years of losing whatever.
Just siphoning off some basis points. It adds up over time. It adds up. It really does. And one thing a lot of people don't know, and I'll mention this because I do think people out there listening that you have those old 401ks at multiple employers and you've just kind of left them there. Something a lot of people don't realize is that generally those plan sponsors, they'll have it written up, the agreement, so they can charge former employees a higher fees than they charge current employees. So the plan that you walk away from,
the current employees.
No, that's exactly right. Yeah. And the employers don't care, right? You don't work there anymore. So I encourage people to.
The other thing too is I now have the flexibility, right? Yeah. So I rolled, like I said, I rolled my wife's into an IRA, put it all in ETFs. That's what she wanted at the time. Since then, she's been more comfortable with putting some of her investments into individual stocks as she's started to gain like 1% of trust in me. So, but now I can, because it's an IRA, right? I'm not locked into, I can't make plan changes when she doesn't work there anymore. So I'm glad I did it. I did have a similar experience to what you did. I just had it like way earlier when I knew less than I do now. All right. So I think I want to wrap up the conversation by taking a step back and thinking about, to me, what we're basically saying with all of this stuff is, and I guess if I were to, I'm not a financial advisor, but if someone were to ask me for my opinion on how to start out, I think what I would start with is actually, let's take a second to talk about what you're actually trying to do with this money, right? Because I don't think I had that clear understanding of like, we need to have a conversation now at age 21 about what you want to do with your life when you stop working, which is hard to do because that's the last thing you're worrying about when you're 21.
Right.
But it's the way I've explained it to my younger son, who has, he's 4 years younger than his older brother. So he has 4 years less understanding of how money works. But the way I explained it to him was, at some point, everyone stops working. And from that moment until they die, they have to pay for stuff.
Yeah.
That's why you invest. Right. And I think he understands that, right? That's a basic enough concept. So I think that's sort of like, we've talked before about goals versus incentives. I think starting with the goal for all of this, I think it's the goal too. Sometimes when I have these fits of like, I want to start over, I want to sell all my stocks, I want to do this, I want to do that, I have to take a step back and say, hold on. When I met with a financial advisor last year, when I run the free retirement calculators on my brokerage accounts and all the things, everything tells me I'm on track to retire very comfortably.
Yeah.
So stop.
Right.
Right. That's how I have to check myself constantly, right? Like, I want to do the things, I'm predispositioned towards action, which I think is just a human condition. But in reality, I should probably lose all my passwords for the next 20 years.
So there's two things real quick. These are kind of my last two thoughts before I just want to talk quickly about tools and frameworks as the closing. I talk a lot about, incentives and motivation, and something that would have really motivated younger me, because it certainly motivates older me, is I'm pretty lazy, and getting really rich, hardworking people to work for me is pretty awesome, right? And that's what happens when you buy Apple like 15 years ago, or CrowdStrike or KNSL Capital. You get some of the sharpest minds in their industries creating value, working for you, like directly, because you're an investor right alongside them. And I think that's a pretty compelling thing. But the other thing that I think matters too is, and I think this conversation works good when you're young and as you age, and that is putting your finances where your values are. And when you're early 20s, your values are more about the things that you're experiencing in your life with your friends and your social group and activities that you participate. But you still also value making sure future you has the resources as well, and making sure that future you's financial resources are aligned with whatever future you's values may be, right? So remembering what your values are and aligning your financial life with your values is another thing that's going to lead you to financial success.
Yeah. Well said.
All right. Last thing, we haven't really talked about it, but I think this is important to spend a couple seconds talking about, because on the podcast, we've talked about frameworks in the toolbox. And I think a big part of this is, as your financial life changes and you move through that continuum, the tools that you need might change, but it gets back to having the framework. And it's something I haven't said on the show in a long time that I want to make sure to say. And that's the idea of frameworks versus rules. Rules tell you what to do. Frameworks tell you how to think, help you think through the things to make the right decision. And rules can be dangerous because if the rules don't change, but the environment has, then the rules might not apply anymore. So making sure you build a framework around your goals and incentives and also your values is going to help lead to better outcomes.
Yeah. And I mean, that's what I was saying when I have to stop myself, right? Like, it's the keeping the goal in mind. Or another way, we've said it this way before on the podcast, right? Focusing on that bottom line of your brokerage account that adds all the stocks up, or the bottom line of your spreadsheet that keeps track of all of your accounts versus the individual things, right? Yeah. So because you can get obsessed with, what did Apple do this week? What did CrowdStrike do this week? What did KNSL, just to use the three companies you mentioned, and you can lose sight of, but my whole portfolio is up, whatever, 100% over the past 10 years, right? Like there's different ways to distract yourself. All right, before we go, quick reminder, quick housekeeping. If you want more content from Jason and I, please check out our YouTube channel. You can also subscribe to our Patreon. There's a free way to subscribe to the Patreon, by the way. There is a free level, and it's just another way to listen to the podcast and see what we're up to. But you can also pay the $5 a month to join Starter Position, get limited ad versions of the podcast, and join our Discord community and talk to Jason and I and a bunch of other fun investors all day long. You can check out our Savvy Trader if you want to see us put the framework into action with actual monthly stock picks. We are still beating the market, so check us out there. And lastly, but maybe most importantly, if you could give us a review and a rating on the podcast apps, that would really help. We've seen some nice momentum lately in terms of people finding the show. So we want to thank all of you that have shared it with friends, told people about it, given us 5 stars, and given us reviews.
Yeah, much appreciated. And just look in the description. You'll see all of that stuff. There's a whole, what did I say it was? It's a Cheesecake Factory's menu worth of.
That's right. Our show notes are like a Cheesecake Factory menu.
They are. You'll find some good stuff in there. So, all right, Jeff, I guess we're ready to wrap this thing up.
Do it.
All right, everybody. As always, we like to remind you that we love giving our answers to these hard investing questions. Talk about what we would do if we hit reset on our portfolios. Our answers aren't necessarily your answers. It's up to you to find your answers out there. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.